Good morning, everybody. Hi, John.
Hey, Manus.
Yeah, you're very welcome, everybody. This is Manus Rooney here from the Brexit unit in Enterprise Ireland, and this is actually the fifth in a series of our Brexit webinar. So we've actually taken quite a journey in the last couple of weeks around some of the main topics of Brexit in the last, I suppose, year and a half, 2 years that we've seen coming through our various activities and clinics around the country. So we have looked at customs, we've looked at managing supplier relationships. We had a wonderful webinar yesterday on the whole topic of movement of people, which is particularly of interest for any of our companies, particularly in the services side, where their people rather than their product is their key asset. So that one is there is also available to look back into. But today we're back on the topic of financial and currency management. So the last time, John, we had you, we looked at the whole area of currency management. Actually, which reminds me, I think you said you would, or maybe I asked you to help us predict some currencies for the next week or two over Brexit. You never got back to us on that one, so I might have to pick you up on that one later on. But so today, John, we're looking not at currency, but we're going to have a little look at the whole area of working capital. And I suppose probably for a lot of people that are listening to this today, but the thing that might jump out to them is this whole area of, I suppose, stockpiling. You would have heard in the media about whether it's Weetabix being stockpiled or Pringles. Um, that's obviously one area of working capital. And I suppose what today we're going to do is look into some of the other areas of potential impact around Brexit. So, so maybe a quick review again of some housekeeping. So that we hope to keep this pretty short, so 40 minutes or so. We'll have about some time, 5 or 10 minutes at the end for some questions, and you can also submit some questions. You'll see at the bottom left-hand corner of your page, an instant messaging icon where you can submit some questions, or you can email it to brexit-unit@enterprise-ireland.com, and we'll try to get to some of those later on. So, firstly, let me just introduce John. So, John, as I mentioned, he covered for us the area of currency and risk management recently. He's back today to look at the whole area of working capital. So John is the MD of SGL. That's about 20 years of experience in financial services. I suppose most importantly, he's been working with us in the last year and a half, 2 years, with our various activities around the country, various clinics. So some really good insights of some of the best practice that he has seen from Irish companies, and as well some of the quick fixes that companies can do just to try to mitigate some of these Brexit risks that are happening around us right now. So how does that sound, John?
Sounds perfect, Manus.
Great stuff. Okay, so try to set the scene a bit, John, around working capital. And I think I mentioned when I was third thought about working capital, you often think about sort of stockpiling. And I think it was maybe back in a hotel in Galway about 6 or 7 months ago. We were kind of having a catch up with a cup of coffee, and you mentioned things around, the whole credit issues around managing working capital around these uncertain times and the impact that might have. So that was sort of the germ of the idea. But what's your sense of working capital and the potential Brexit impact that we might see over the next sort of weeks and months?
Yeah, I mean, like working capital is very simple in its simplest form. Working capital is the longest form of capital that a company will require. It's your operational capital. It's the money that's used to keep the business going on a day-to-day basis. I think somebody had a great quote to me the other day. I met a CEO the other day who turned around to me and he said, "Over my gravestone will be here lies the man who died, who had constant strain on working capital." So it's probably for all of those, for those of you listening today, I think you'll probably find it's your constant worry. It's constantly required. And it is the money, it is the blood that runs through the company to keep it going and to keep it alive. And it needs to be pumped. So the heart of the business needs to pump that working capital through the business to make sure that you can grow and sustain. You can go out and buy, fixtures and fittings, or plant machinery or property, or get equity into the business. But the working capital is what keeps it going on a day-to-day basis, and that's why it's so critical. And we'll talk a little bit about what they call the operating cycle or the cash cycle, and that is a critical part of how you manage that working capital challenge. So that's what we'll touch on today.
Okay, so I think, yeah, even if you manage to reduce some of that working capital stress for people, that'd be a wonderful outcome for people to walk away from the webinar. So, that's a lofty goal, John. So, I'd like to give you some ambitious targets. So, listen, that's it for me. I'll drop back later, and we can catch up again for some of the questions and answers.
Brilliant. So look, I'm going to take it from here. So we're going to spend the next 20 minutes or so just having a chat about what working capital might look like, what that working capital cycle, how it's structured, what you can do internally in the business to manage that working capital strain, particularly in the face of Brexit. Some of those mechanisms we speak about, whether we'll have a soft Brexit where ideally, nothing will change in the short term. We'll have this interim period, or to prepare for what would be the worst case scenario, which would be a hard Brexit. So we'll speak about all of those mechanisms that can be done firstly internally, and then once you've exhausted everything that we can do internally within our companies, we'll speak about what can be accessed and what is available externally to support the business and to support that working capital that may be required if there is a funding gap within the business. So very simple. So we'll have an overview. So uh, as Mana said, we've been privileged to work with a lot of companies over the last number of years, and looking at what some companies are doing very well and what other companies are aspiring to, and we've tried to take some of those best practices, and we've tried to also verbalize what these companies are saying and where they're finding the challenge. So we'll speak a little bit about that. I do want to speak about that working capital and that working capital cycle, and where in that working capital cycle companies may be impacted by Brexit and what those impacts may look like. We're going to look at how those impacts may be mitigated internally, and then we'll look at some of the working capital financing options that are available externally through all the banks, non-banks, and state agencies. So we'll look at all those, and then a few tips and tactics that you could employ very quickly to help you along that road. And then we'll have a Q&A at the end. So the considerations for companies, as Mana said, we've already looked at the challenges that companies face in terms of their working capital cycle. The last session we did was around currency and how to mitigate currency, but there are other aspects. That working capital cycle is what we're focusing on today. But also what leads on from that is, while you have this working capital cycle, while you have debtors in the business, getting paid is a critical part of that. As we say constantly, cash is king in any business, and getting paid is critical. And could that be impacted by a Brexit event? We'll speak a little bit about that. Currency we've already spoken about, and also the potential of tax and customs, and what the implications could be on that working capital cycle, on the cash available in the business, what those tax and customs may look like. We've all heard that customs and tariffs may come in. We've also all heard that trade with the UK may now become a vatable, a third market, which means imports and exports may carry a VAT element to them. So we'll speak a little bit about that and some of the supports that may be available. So that's the considerations for companies. What are companies saying? And that is where I'm going to focus the next minute or two on. Okay, so what is the word on the street from a lot of companies? A lot of companies are asking, yeah, we are aware that we have a challenge coming down the line, but how will we fund the potential additional costs? And they are soft costs and they are hard costs. So as we say, we all are aware of potential hard costs that could be coming down the road: tariffs, customs, lengthening of the cash cycle, potential VAT implications on the working capital that may be available. But there are also other considerations, like we may have additional administration and overhead to manage this process. So have we quantified those costs, and how do we fund those additional costs? Is there scope within the business to manage those additional costs? We would need or require additional capital. And a lot of companies are asking, do we actually need that, and how do we quantify that? And that only comes from having a robust budgeting and forecasting model where you can step in and you can stress test that budget and that forecast to know where the additional capital will be required, and also importantly when that would be required and the type of capital that would be required. So having the capital appropriate to the requirement is critical as well. We've good credit terms with our suppliers. So as I say, if you can maximize the credit terms at both sides of the transaction, this is ideal. However, credit terms with suppliers and your credit terms to your customers, if they are in the UK, um, could potentially change. And I'm going to speak about a little bit about that later on, and things to be aware of and how you could address them and be very proactive about addressing that. So, what additional costs could there be? I mentioned them already. So a lot of companies are asking a little bit of crystal ball gazing here. So, but we've all aware that if we do have a disruptive Brexit process, potentially we could have tariff on imports coming in, tariffs on our exports going into the UK. We potentially have VAT as an implication. Now, VAT is an impact on cash flow. Okay, so it shouldn't be an additional cost, but it has an impact on the cash flow of the business because it has to be paid, and there's a process to recover. So it does impact on the company's cash flow and cash reserves. We get this a lot. I know I have a requirement for additional capital, but capital is expensive. Um, and credit is expensive, and there is a perception out there that credit can be expensive. Very often that arises where the company has perhaps chosen the incorrect or the inappropriate form of capital for their requirement. If it's identified and priced correctly, that capital and that credit should only enhance the business. So we'll speak a little bit about that. I think companies are very often seeking the wrong type of credit or capital for the requirement they have in the business, and then don't know what we require. Unbelievably common statement. We're operating in a vacuum of not enough knowledge. So how do you plan for something that you don't know is going to happen? And I'm probably going to I'm going to take the phrase of the Roy Keane phrase. You plan for the best, you hope for the best and plan for the worst, and you take the worst case scenario, you stress test the business, and then you plan for that. Nobody says, by the way, if there's a credit requirement or a capital requirement, you can prepare for that. You don't necessarily have to draw down immediately, but you can prepare and go through the process. So I'm going to reflect back a couple of times on a little case study here. And the case study I like to use is an engineering company. 30% sales in the UK, 70% of material is sourced from the UK. They have relatively stable cash flows, contractual and credit terms in place, 60 days credit given to customers, 90 days received from suppliers. So the ideal scenario, right? So you're getting more credit from suppliers than you're actually giving to customers. So that's the perfect scenario for somebody, which means that they can theoretically get their goods in, processed, sold, and effectively be paid by your suppliers be paid by your customers by the time you have to pay your suppliers. The ideal scenario: 40% gross margin, 12% net margin. That net margin is an important number, particularly if there is any type of credit requirement, because the net margin is telling you the scope of the company and to take on additional credit, but also at what cost they could take that credit on it. Okay, and then various assumptions that sit in behind that. So quickly moving on from that, and this is just a graphic that I use sometimes around what is the working capital cycle, and lots of you will hear different terms around working capital. Many of you may know that my own background is in working capital financing down through the years, but the working capital cycle is the moment from which a customer places an order with you all the way through. So I hope you can see the arrow, but from the moment that the customer places the order with you, which is number one, all the way through to the purple where the customer pays you. That is effectively your working capital cycle or your operating cycle. And that operating cycle can be very short for some businesses. For instance, if you're a SaaS business, a software business, where the moment you provide the service, you get paid for it. That can be quite a short operating cycle, all the way through to our engineering business, which can see quite a lengthy operating cycle. 4, 5, 6 months can be common. And the pinch points that we go around, and if we look at our operating cycle, the customer places the order with you, you place your order with your supplier. So going back to our engineering company, they've placed their order with their supplier in the UK. Those goods then have to be shipped, all right? But the supplier, in this case, the engineering company, is providing 90 days credit. One of the pinch points may be that the supplier in the UK may find it difficult to provide credit to their Irish customers for a number of reasons. One may be they may be discounting their invoices, and the invoice discounter may be uncomfortable with now securing against the Irish invoice. That could be a reason. They may find it difficult to secure against those Irish invoices. So that maybe those supplier terms could potentially change depending on the scenario we're in. So supplier needs payment. In this case, he's given credit. The goods are then shipped. And when the goods are shipped, and we're at number 4 here, the light green, goods are shipped. And if the UK is going to be a third country and we have a disruptive Brexit, the Incoterms that will apply to those goods being shipped, and the Incoterms are effectively the import and export terms and conditions around those goods. So, for instance, when who has responsibility for the shipping? Who has responsibility for the insurance during shipping and transport? When does the title transfer on those goods? Is it at the port? Is it at the factory gate? All of these terms begin to come in because the Incoterms will then dictate who is responsible as we move from the number 4 to number 5, where the goods are received by you. We have entry into entry at the port. So who is responsible for any potential customs, VAT, and duties that may apply at that point? So those Incoterms will be important at that stage. The company here, the engineering company, will then process those goods and then deliver them back to their customer in the UK. So we now have inward and outward processing, and there are supports by revenue. I think the customs guys have already gone through that. That will help you. That will help companies along that route. We then raise that invoice for the UK customer. We're giving the UK customer 60 days credit. The opposite applies to your supplier, in that, is your invoice financer going to be comfortable financing a UK invoice? And that is something that I would encourage everybody to engage with their financer. If you already have one, engage with them to make sure that they are going to be able to continue financing those invoices you have going into the UK, because that potentially could be an issue, and we want to preempt that before it ever arises. So engage with your financer at that stage, and then the customer pays, and that's the cash cycle. That cash cycle can be lengthy. Okay. So how do we finance any pinch points around that cycle? And that is going to be, I believe, a critical part, because for me, having looked at, a large number of companies at this stage, and having engaged with them and spoken through their requirements and their challenges with Brexit, I feel that cash cycle is going to lengthen. And if that cash cycle lengthens, it lengthens the period of time. So what I mean by lengthen is supplier terms may reduce and customers may demand further credit or longer credit terms. It will take longer to get goods out. There may be delays at the entry points and at the ports. That cash cycle will lengthen. If that cash cycle lengthens, you're further away from being paid. From the moment you order goods and pay for them to the moment you get paid, that cash cycle will lengthen. That will create a funding gap, and we want to make sure that we can fund that funding gap uh, adequately and without stress. And I'm going to give you some tips and tactics as we go through this. Um, so managing the working capital internally, and this might seem quite simple to many, but we just want to reiterate it. Okay, you want to maximize the credit terms from your suppliers. When I say maximize, I certainly mean try and maintain the terms you already have in place. So this engineering company that we're using as an example, they have 90 days credit with their supplier in the UK. At a minimum, they want to try and maintain that 90 days credit. Okay. And I will come back to that in a minute, because I do have a strategy around helping a company there. Efficient credit control. All right. So staying on top of your debtors is critical. So lots of Irish companies tend to make the sale, send the invoice, and perhaps not be as effective or efficient at collecting the money. We should really get very efficient at credit control and keeping our aged debtors and our aged debtor periods and our average debtor days to a minimum, to ensure that for the gap between the invoice date and the payment date is minimized as much as possible. We want to familiarize ourselves with the new, but also the existing arrangements in place. And a lot of the new and existing arrangements in place are in the event of what we call a disruptive Brexit. Ideally, we have a pretty smooth Brexit where we have a transition period where nothing changes. But in the event we do have a disruptive one, the revenue have put in some mechanisms, and they have some proposed mechanisms on the way. Some of those are around. Some of you may be aware that if you bring goods into Ireland from a third country, when they land at the port, there may be either VAT, customs, excise, or VRT if it's a vehicle. They're all due at the point at the entry point. The revenue either will have a cash transaction there and then, or you can have what's called a deferred payment authorization, which means that it's effectively a SEPA or a DD, a direct debit mandate, for the following month for the amount. To get a deferred payment authorization, you must provide a comprehensive guarantee, and that comprehensive guarantee can have it must be sought from the revenue prior to getting a deferred payment authorization. So for those of you who may be considering that, certainly go ahead, and that will help cash flow. It will defer the payment for 1 month post the goods entering in. That deferred payment authorization can be for VAT, customs, excise, and VRT. The other one that is proposed, and it's proposed in terms of if we have a no deal Brexit, is what they've called a VAT deferral. So the revenue have suggested that we would maintain the existing a similar structure to the current inter alia VAT, where you would not have VAT payable at the point of entry. It would simply be accounted for at the end of your normal VAT period, which would be every 2 months for most companies, which in simple effect means that you're not having to pay out cash at the point of entry in terms of VAT, which impacts on your cash flow. All right, huge benefit to a lot of companies if we are in that scenario, that you don't have to worry about having to suddenly pay out 23% in VAT at the point of entry before ever receiving your goods. I think that is a critical piece. So a little bit of good news there in the event of a difficult Brexit. Managing the customer and supplier terms into the future. Cash and that's managing those customer supplier terms into the future, particularly from a contractual basis. You want to maximize those supplier terms and minimize the customer credit that you're giving to your customers. All right, so you just want to manage that flow. And remember, cash is king. Retain sufficient amount of cash, because there's going to be a strain. I speak of a strain on working capital constantly, but that cash cycle will lengthen. We want to make sure that we have enough capital in the business to withstand the strain that may come on working capital, particularly maybe from suppliers. After exhausting your internal, there are a number of financing options that are available out there, and I'm going to fly through these. A lot of you would have heard me speak about these before, but in simple terms, you have a number of external financing available. I speak about post-shipment finance, which is effectively once you've sold your goods and you have an invoice. There are a number of finance options available. We now have invoice finance, which means that you can get paid upfront. Up to 90% of the invoice can be paid to you straight away. And if we take our engineering company, they've sold their goods, they have 60 days credit with their customer. So they get paid straight away now, 90% of the invoice. And in 60 days, the customer will pay. The invoice finance company will take their interest rate and their margin, and the balance goes back to you. Okay, so there's cost structures that vary. You have what I call full ledger, which is where typically done by the mainstream banks, where they take a security over the entire ledger, um, and it's at quite a reasonable cost. But we also now have single debtor and even down to granular single invoice financing, where you can actually take one single debtor who might be a large customer who demands a lot of credit. You can take that single debtor and finance them separately out for the rest of your ledger. Very beneficial. You might also have a very large contract where it's a very large single invoice, and you can actually finance that single invoice now, which will take the cash flow strain away from the business. Factoring is another form of it, where you actually give away the entire credit control to the invoice finance company, where they do the collection, they do the engagement with the customer, they collect from the customer. Some people like it, some people don't. We also have our traditional mechanisms from the mainstream banks, our overdraft, which have shrunk over the years. Term loans, what I would say about term loans from a mainstream institution, to get it, you must prove capacity to repay. Always. Capacity to repay is everything. They also do stocking loans. So Manus mentioned about companies stocking up on stock. So a lot of the banks are providing stocking loans. Again, it comes down to your capacity to repay that loan and being able to show that within the accounts and the cash flows. And we also have letters of credit. So this comes in where you have a supplier. They can't get comfort around you. And remember, I mentioned about suppliers pulling back on terms. They can't get comfort around you. You can actually give them what's called a letter of credit, which is effectively a bank guarantee or a bank promise to say that if I don't pay you in 60 days, the bank will. Now, that letter of credit is a credit product, and it must be assessed as a credit product under the bank's credit policy. The SPCI, I'll speak about that separately in a second. They have the Brexit loan scheme. They also operate the credit guarantee scheme, and they are hopefully going to launch a new scheme called the Future Growth Loan Fund, which is a similar scheme again. And then we also have what we call pre-shipment finance. And pre-shipment finance is everything before you have an invoice. So it's stock finance, trade finance, and purchase order finance. What I would say to everybody is that pre-shipment finance is the most risky form of finance that an institution can provide, and it's priced accordingly. But in simple terms, trade finance is where you're buying in stock for a transaction. So you're financing the trade. So where they will pay the supplier upfront and deliver the stock to you, and you will pay them back then from either the invoice that you receive payment on or the invoice finance that you get paid on. Stock finance, similar to stocking loans, is there to stock to pre-stock, and then also you have what they call PO finance or purchase order finance. So where the first two are balance sheet driven on your company, the last one is based on the strength of your customer. So if you receive an irrevocable purchase order from your customer, and they're quite a strong customer, creditworthy customer, you can actually purchase in your stock using purchase order finance to get it delivered to you, processed, and out the door. So when you look back at our example here, that company, that engineering company, they could buy their steel in. If they have a large purchase order, or if they have a large purchase order from a customer at the other side, they could actually finance the purchase of their stock that way. So the Brexit loan scheme, and I'm sure you've all heard lots about the Brexit loan scheme. For me personally, I think it's a wonderful scheme. It is a game changer in terms of credit and banking in Ireland, where effectively up to the first $500,000 is unsecured. Okay, which, as all of you will be aware, we're used to having, security packages in place for credit, personal guarantees. The SBCI loan is designed to assist companies with their working capital challenges. It's quite rigid in its structure. It's a 3-year loan, repaid over the term. You can have interest only for the first year. The maximum loan rate that can be charged on it is 4%. Loans are offered between 25k and 1.5 million. The first 500k is unsecured. All right, it carries a state guarantee with it. So, and over 500k, there's a 20% of the loan is required as security. It's a two-step application process, so this sometimes can be confusing for people. Your qualification criteria is done via the SBCI, the Strategic Banking Corporation. However, they will then give you a PIN, and you take it to one of the three main banks, AIB, Bank of Ireland, or Ulster Bank, where the bank will do a credit assessment under the bank's own credit policy. Okay? The advantage here is that you don't have to worry about collateral. The only thing you have to prove is your capacity to repay that loan. Okay? And as I said, no personal guarantees. So I would urge everybody to have a look at that Brexit loan scheme. The new scheme coming out, the Future Growth Loan Fund, is similar in nature, except it's designed to be longer. I think it's going to be up to 10 years, but that's not confirmed as yet. So just to wind up a little bit, some of the tips and tactics. All right, ensure internally that the cash cycle is as efficient as possible. So you're going to try and lengthen your credit terms with your suppliers and shrink your customer credit days that you're giving. Okay, review contracts with both suppliers and customers to ensure that the longest possible credit is received. Okay, engage with your UK customers and suppliers. What are they doing? All right, ensure that credit. You want to double check your credit from those UK suppliers to make sure that they are going to continue to be in a position to give you credit post-Brexit. Credit insurance, and this is a slightly quirky one, but it's very relevant. Credit insurance, most companies who give you credit will probably 70% of the time will have you credit insured. So you want to ensure your credit standing is as good as possible. The credit insurance companies are usually working off very old information. Filed accounts that you've made for 2017, which only went in at the end of last year. They're working off information that's 18 months old. So if you've had a very good 2018 and your management accounts are really good for the first 3 months of 2019, you can supply that information into some of the credit insurance companies, which they will then feed into their system, which will boost your credit and the amount of credit that you can be insured for. And I would urge a lot of people to do that. There's nothing stopping you doing it. Okay, so it's all about providing up-to-date information for these agencies so that they can give you the best possible credit terms and credit limits available. Hope for the best, but plan for the worst. Okay, so we're still planning for a potential hard Brexit. No matter what the probability of it is still a possibility. So we want to plan for that. And anybody who's seen me speak before, you'll always have heard me speak about understanding what the best type of finance is that suits the business, but also suits the needs. There is no point in taking on, expensive equity for working capital. There's no point in taking on 10-year loans if it's for a 3-month transaction, okay, and trying to pay that down then over the 10 years. Make sure that the type of finance that you seek best suits the needs and the business. All right, and when I speak about the margin earlier on, the margin will dictate what the type of finance the business can sustain, particularly from a cost and what they call how fast that is rotating. Okay. In terms of ask your customers and suppliers what their Brexit plan is, I would always engage with your customers and suppliers, particularly in the UK. Ask them what their plan is. Okay, research the options available. There's never been more choice and diversity available. Okay, in terms of finance, when you look at the FinTech Ireland map of fintech companies available in the island of Ireland alone, it's never been more diverse and it's never been more choice available, and that doesn't capture the entire market. So research the options available. Going back to credit insurance and your credit standing, there's lots of credit referencing sites out there, Credit Safe, and a number of other ones where they will give you a credit limit on yourself. But also, if your performance in the previous 12 months has been better this year than it was the previous year, the likelihood is your credit limit would increase by simply supplying some of that information into the market leaders. For instance, Euler Hermes would be probably the largest credit insurer in the world. They have 40% global market share, and that would filter down, I think, to a lot of the agencies, a lot of the other credit insurers that are out there, the likes of Coface, Atradius, and a number of others. So that's how you would manage that process. We've spoken quite a lot about a number of factors there. I do want to go back to one thing, and I've mentioned suppliers a few times, and we've come across one or two companies who have been very proactive in how they manage those suppliers. We came across one in particular who had made sure that they had sufficient capital to manage Brexit. Their supplier came back and said, we have to reduce our credit terms. They were on 60 days credits. They came back and wanted only 2 weeks. But the company was in a position to agree that with the supplier. But not only did they agree it, they agreed an early settlement discount for paying early. The early settlement discount compensated them, more than compensated them, for the cost of the credit to have that capital available to do that. So sometimes it does make sense to be very clever about how you structure that cash cycle and how you would maximize the terms that, if they were to change, that they can work best for you. And that's only one simple little tactic that I've seen that really worked well for this particular company. So in summary, I think the cash cycle may lengthen. I think it's very likely. Brexit will disrupt. So I would say that make sure you have sufficient capital within that working capital cycle and within that cash cycle. Make sure there's sufficient capital available for the known and the unknowns. Maximize that those internal cash resources. Money tied up in debtors, get it in. Make sure your credit control is really, really efficient. Ensure that the finance, if you go for external finance, make sure it's appropriate to the requirements of the business. And lastly, if you are going for credit, the credit process takes time. You don't necessarily have to draw down as soon as you're approved. There's usually a window of a couple of months, but at least you have the credit process undertaken and done, and you know what's available. So don't delay. The credit process does take time. So on that note, I'm going to hand it back to Manus. Thank you.
Great, thanks, John. I think some really useful bits there. Particularly that example there you had from the company about just very simple around early payment discount. It just shows you some things that can actually give you some really, really benefits actually, if in terms of what looked like initially as a bad case turned into actually quite a good case. So,
Yeah.
John, we have a few questions coming through, and I have one or two myself. So particularly, I wanted to just talk firstly about the whole area of VAT, and that's one thing we get asked quite a bit in the Brexit unit in Enterprise Ireland, is the implications of VAT. So would you mind just going quite slowly for us, or slowly for me in particular? What is the implications of VAT when you trade with a European country versus trading with a third country, which case the
Okay.
UK would be?
Okay. So my apologies for how I explained this, but first and foremost, VAT is a minefield. So you want to just, there are specialists out there who spend their lives working just solely on VAT. But remember, VAT by its definition is really only payable once, and that is really by the end customer. So there are offsets all the way along when it comes to VAT. So the purchases you make against the sales you make, the VAT is offset all the way along the line. So when you trade within the European Union, all your transactions do not carry VAT. It's what they call inter alia. So you buy goods in from the UK at present, they don't have VAT attaching to them. So they land here exempt from VAT. All right. So you buy stock for €100, you pay €100 for them. and they land in your warehouse and you have them. Okay? When you trade with a third country, the third country, we now have VAT at the point of entry. Okay? So the €100, so the UK may change to being a third country. In that case, the €100 of stock that you are buying, when it lands at Dublin Port, carries with it is a vatable transaction. So there are up to 23% added to that. That 23%, all things being equal, if the revenue do not make any changes and the UK is a third country, that 23% would have to be paid at the port, at the point of entry. That's a cash call on the business. That 23% or that 23,000 has to be paid then and there. Okay? And the proposal from the revenue in the event of a hard Brexit to defer that payment is a huge benefit to a lot of companies because it's not a cash call there and then on the business. So in that case, if the company had to pay that VAT at the point of entry, they would have to wait up to a further 2 months or more to recover that payment through their VAT return. And that creates a strain on working capital. And that's the big difference. And that's why companies are concerned about the implications of things like VAT. It's the impact on the cash available within the business, within that operating cycle.
Okay, and just another kind of aside one to that too, John, is again we get asked this quite a lot, is do we have to, does an Irish then company have to pay UK VAT as it leaves the UK, as well as you mentioned there already the VAT at point of entry? What about the UK
Yeah,
VAT?
so the UK company would have to it sorry, in simple terms, no, the UK company shouldn't be selling with VAT attaching if the goods are leaving the UK. So what the UK company would do is they would have an export declaration that they would have that might attach with it the invoice from the Irish company, or the invoice to the Irish company, or the bill of lading, just to show revenue that these goods are leaving the country, and that there would be no VAT carrying on those goods leaving the country. Where that might where the only stipulation there is that if a company is operating in the UK and they have expenses in the UK that have been incurred over there and they've paid VAT on them, they can recover that VAT. But again, that takes time, and lots of people will know about that who are already trading over there. Recovery of VAT by an Irish company in the UK can be a lengthy process. So again,
Okay.
it all creates cash strain. That's what I'm trying to say.
Okay, so time seems a big
Yeah.
impact on all this. John, you mentioned a few times cash is king, and also to be sure that you have sufficient cash in the business. You know what I'm going to ask right now, John, is what's the definition of sufficient? And I suppose how does a small business try to stress test some of these things? And just in very simple terms, how do they understand or determine what sufficient is for their own business?
Um, and this is where really good planning and forecasting comes in, because if you have a really good planning and forecasting model in place, well, then you can stress test that. So then you can start saying, well, if what if my goods cost me, all things being equal, you can quantify the amount of resources required and bring that down to a unit price level. So what if we have to absorb that additional cost? What if we have a delay on receiving goods, and what if we have a delay on shipping goods? So that delay might only be a day or two, or but when you put that over multiple products and multiple sales, you end up with this stretch on your cash cycle, and it might end up to be, on a 3 or 6 month basis, you might find that you have a strain on your total turnover of 3, 4, 5% within within your uh, within your cash of total turnover, and that's what it might be quantified as. Uh, you might also decide that we might lose